Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday ETF and combined with the stock market report for March 14th, 2026. And the reason we're doing that is because a lot of the slides are going to overlap, so we decided to put it all into one under these present market conditions. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us take a look at the volatility bands on the S&P 500. And I'm recording this in the afternoon on Friday, a couple hours before the market closes. And these are volatility bands. And this is the 20-day moving average in here. And we have the bottom volatility band here. Yesterday, which was Thursday, we closed below that band by a long shot. Today, we opened below it, we went above it, and tried to test this area in here. Didn't stay there for more than 2 minutes, and now it's coming down and under yesterday's low. So this is an important signal in here that's telling us it's not very nice out there right now. And all the way down here, we can see this indicator is way in oversold condition, and it's still pointing that way, so it's got a ways to go. Now let us look at the S&P 500, same chart as I just showed you, except the volatility bands are not in there, and I want you to notice this red line down here. This is the 200-day moving average, and we are heading there very, very quickly, and maybe even Monday we just might hit that, because that's only about 50 points away as I'm recording this right now. And let's look at a long time frame of what this means, this 200-day moving average in here. We go back 10 years. This is the S&P 500, and this is the 200-day moving average. And you can see there have been only a couple of times back in October 2019, so, or a little later than that, a couple of days later, it fell below it. And once it breaks through, and you can see there's bounce up, down below, bounce up, bounce below, and then finally broke down. It came all the way over here, and this is 2020, and here, what was that? Yeah, COVID. And when it dropped. But look how fast it came back. Look how fast this previous one came back in 2019. Then we came into 2022 when we broke below that 200-day moving average, and that was just a plain nasty year. And remember, I keep saying that it wasn't officially a recession year. Well, the stock market says it was. And now this is the S&P 500 down 19.6%. The NASDAQ was down 34%. So if that's not a bad recessionary market, I don't know what is. And then all the way over here, broke through just a little bit. And over here, what is this? This was the tariffs last year, at the beginning of last year. And now we're here, and we're starting to roll over, and we're coming very close to that 200-day moving average. So the key is it going to bounce above it like it did over here, or is it going to go below it and then come bouncing back? So that's always a good question, isn't it? And that's why I wanted to put these two together, because I wanted to show you very, very similar charts. Now, this is the IYT. This is the transportation average. And remember last week in the ETF section, we talked about the transportation average actually reaching a new high in here over years and years and years and years. So we were doing very, very well until all of a sudden this war broke out. So this is a leading indicator. Remember the old Dow theory that the transportations had to acknowledge that the S&P or the Dow at that time was making new highs. It had to be accompanied by the transportation average, because everything travels that we produce. Either we fly it, we drive it, we put it on a boat or a ship. And this broke down last week, so we showed this last week, and it's continued breaking down that bottom band. So again, this red line is the bottom volatility band, and this red line here is, yep, the 200-day moving average. We're very, very close to that. So we're at some critical points in here, folks. Now, let's look at what is working. Yeah, the green line up here is the oil and gas, and that's up 32%. This is year to date, folks. And the red line here is the energy, up 28%. The oil and gas was up 32%. I don't think I mentioned that. Look at the semiconductors down here. They're actually up. Now, the S&P 500 is down over 2.5% as I'm recording this. So when you have something up 1.5%, that's very, very good. And the tech ETF down here, down 4.7%. You would expect both of these to be below the S&P 500, but only the tech sector is. But the semiconductors are doing fairly well. They're holding in, and they're still up 1.5%, actually 1.6%. So that's why I wanted to combine these, because I want to show you, yeah, there is something working. It's just not exactly what we want it to work, because that hurts everything else. If oil and gas is going up and the rest of the energy sector is going up, usually the market is going the opposite way. Let us look at the dividend growth and income portfolio. We showed this last week. We are up 4.57%. So call it 4.6%. That's pretty nice. The stocks themselves are up 3.77%. We've already received a dividend of 80 cents, and that's supposed to be cents and not percent. But now we're up 4.57%. The S&P down here, down 2.9%. I said 2.5% before. No, it's 2.9%. It'll be down 3% before the end of the day. And look what is up, though, the XLU. That's the utility index. And the utility index is acting very, very well. One of the reasons is because there is so much of the AI build-out going on, those AI factories that are out there, that the utilities are increasing their transportation systems, which are the wires that we look at every day, and also their generating capacity. And that's why the General Electric Vernova that we added to our growth portfolio is doing so well, because that can make gas turbines on site that produce a lot of electricity. And some of those housing stocks are also into installing electricity, and they are also doing very, very well, because a lot of the electricity that's being used in those AI build-out units, 40% of it goes for cooling. That's why some of the housing stocks are doing so well, because they install air conditioning. So what is doing well? Not so much the home builders, but the companies that are involved in putting in cabinets, or putting in the toilets in the bathroom, putting in insulation, putting in air conditioning and heating too. There are cold parts of the country. Sometimes you forget about it when you're living down here in Florida. But that's why the XLU is doing well, because it's all about the AI build out. So they're doing exceptionally well. And we went over that in one of our ETFs about 3 or 4 weeks ago, maybe even 5 weeks ago. So what's working? The Buffett and Beyond dividend growth and income portfolio up 4.6%, up 4.57%. The utilities are working, energy is working, oil and gas is working, and everything else is just not. And so the market, the S&P is only down 3% for the year, 2.9% for the year, but it's down from its high a little bit more than that. So we have to be very, very careful with what's going on this coming week, because we're looking at that 200-day moving average. And let's go over the put protections, and this is a combination of the ETF and the stock market letter. So we're putting them both together. I just want to show you that with the SPYs at 664, remember the SPYs are 1/10 of the S&P 500. And we have these in place for those of you who want them in place. And this put is worth about 2.5 times what it was paid for. And now the QQQ portfolio protection, that's the NASDAQ 100, this one is worth 3 times what was paid for it. And I'm looking at the May 15s here. So 3 times. So these puts, if you're using them, are helping to cushion your portfolio very, very well. But right now, the market is saying, yeah, we're a little bit scared in here. The value of these puts are rising very, very quickly. So both the SPY puts, if you're more into, say, the dividend growth and income portfolio, but most of you don't even buy put protection for that portfolio. And the other one is if you're inclined more to the tech and the semiconductor area. Those are volatile areas, or more volatile than the market, than the S&P 500, and that's why this put is worth almost 3 times what we paid for it just a couple of weeks ago, last week, 2 weeks ago, 3 weeks ago. So anyway, they're doing very, very well. So folks, we're having a tough weekend here. We're having a tough beginning of the year in here. The first 2.5 months are just not looking so good. We got a lot going on out there, but if you look across that valley and you see green on the other side, yeah, earnings are going up very, very nicely. It's the stock prices that are going down. And as we look at the earnings that we looked at during the week a lot, we see that they are going up very, very nicely. In fact, almost at record pace, not record pace, but close to the top, where you have to say that, okay, earnings are doing very, very well. So that's what we're looking at. The earnings are going up, the prices are going down, and we talked about that this past week and also the week before. So go out. This is a good time to get your mind off the market. Go out and enjoy the weather, whether it's in the snow or whether it's in the sand. Go out, be safe, be with your family, forget about the market. And folks, we'll see you right back here in a couple of days.